Imagine two people. Both are 25 years old. Both earn roughly the same income. Both drink expensive coffee sometimes, order food when they are tired, and occasionally buy things online they probably do not need. But there is one tiny difference. Person number one spends an extra $100 every month without thinking much about it. Person number two quietly invests $100 every single month. Not $1,000. Not $500. Just $100. Fast forward 30 years. One person wonders why building wealth feels impossible. The other has something surprisingly powerful. And here is the strange part. The difference was never really about money. It was about behavior. Because most people massively underestimate what small financial decisions can do over long periods of time. Human brains are not designed to understand slow growth. We notice dramatic changes. We notice big wins. We notice lottery winners. We notice someone buying a luxury car. But we barely notice tiny financial habits. And that misunderstanding quietly keeps millions of people from building wealth. So what actually happens if you invest $100 every month? Can something that small really change your future? And why do most people completely misunderstand the answer? Let's break it down. There is a reason people think $100 is not enough. Because modern life trains us to think in immediate results. If you go to the gym once, nothing changes. Eat healthy for one day, nothing changes. Read 10 pages of a book, nothing changes. Invest $100 one time. Also feels like nothing changed. Your brain immediately says, "What's the point?" Because humans naturally expect effort to create immediate rewards. Psychologists call this present bias. We naturally value rewards today more than rewards years later. That is why spending money feels good instantly. Buying something gives immediate satisfaction. Investing feels boring, sometimes painful. You give away money today for benefits you cannot see. And that creates a problem. People assume wealth comes from huge income, massive business success, perfect stock picks, some secret investment strategy. But reality works differently. For most ordinary people, wealth often comes from consistency. Tiny decisions repeated over long periods. The problem is, long periods are hard to visualize. Let's look at something simple. Imagine you invest $100 every month. That is about $3.30 per day. Less than many people spend on snacks. Less than random online purchases. Less than many subscription services people forget they even have. Now imagine you put that money into investments that historically average around 8% yearly returns. Not guaranteed. Markets move up and down. Some years are amazing. Some years are painful. But historically, long-term investing has rewarded patience. So what happens? Let's start small. After 1 year, you invested $1,200. Nothing exciting. Most people would look at that and say, "See? Not life-changing." But something important quietly started happening. Your money started working. Think about investing like planting trees. The first year looks unimpressive. A tiny seed, small growth, barely noticeable. But trees grow differently over time. Money does too. Now imagine 5 years pass. You invested $6,000. With growth, maybe you now have around $7,000 or more, depending on market performance. Still not dramatic. Still easy to underestimate. This is where most people quit. Because humans hate slow progress. Psychologists discovered something fascinating. People often abandon systems right before they become powerful. Why? Because visible progress arrives later than expected. We expect linear growth, but wealth often grows exponentially, and exponential growth feels invisible, until suddenly it does not. Let's keep going. 10 years. You invested $12,000, but your account may now sit around $18,000. Interesting. Your money is contributing, but now your investments are helping too. Something important changed. You are no longer working alone. Your money joined the team. Now imagine 20 years. You invested $24,000, but your account might grow toward $59,000. Wait, how? You only invested $24,000. Because something powerful happened. Your investments generated returns. Those returns generated more returns. Then those new returns generated even more returns. Money started building money, like a snowball rolling downhill. At first it barely moves, then it grows. Then suddenly, the snowball feels much larger than expected. And here is where people usually become shocked. 30 years, $100 monthly, around 8% average annual return. Total money invested, $36,000. Potential portfolio value, over $140,000. Read that again. You put in $36,000. But the outcome became dramatically larger, because investing is not only about what you contribute, it is about time. Time changes everything. And here is the deeper truth most people miss. The real power is not even the returns. It is behavior. Imagine two investors. Sarah starts investing $100 monthly at age 22. David starts investing $200 monthly at age 35. David invests more money, twice as much. He feels smarter, more aggressive, more serious. But Sarah had something David did not. Time. And time in investing acts almost like a hidden multiplier. People think investing success depends mostly on intelligence. Research often suggests something different. Consistency beats intensity. The best investors are not necessarily the smartest. They are often the people who stay invested, who avoid panic, who keep going, who understand something psychologically difficult. Small actions become huge outcomes when repeated long enough. Imagine filling a bathtub. 1 drop feels meaningless. 10 drops feel meaningless. 100 drops still feel small. Then eventually, the bathtub fills. Financial growth works similarly. Small progress feels invisible until it becomes impossible to ignore. And there is another psychological trap. People wait for the perfect time. I'll invest when I earn more. I'll invest after I pay everything off. I'll invest once life becomes stable. But life rarely becomes perfectly stable. Expenses appear. Unexpected bills happen. Responsibilities grow. And waiting creates a hidden cost. Opportunity cost. Opportunity cost is what you lose by delaying decisions. Imagine someone waits 10 years before investing. They still invest $100 monthly. They still stay consistent. But they lost 10 years of growth, 10 years of compounding, 10 years where money could have quietly worked. That cost often becomes larger than people realize, because compounding needs time. A lot of time. And that creates one of the strangest realities in investing. The beginning matters more than people think, not because your early investments are huge, but because they have the most time to grow. $1 invested today works harder than $1 invested 20 years later. Not because the dollar changed, because time changed. Most people think investing is mainly mathematics. It is not. It is psychology. Think about this. Imagine your investments fall 15%. Suddenly, emotions appear. Fear, doubt, anxiety. Your brain says, "Get out. Stop losing money. Wait until things feel safe." But markets rarely reward emotional decisions. The challenge is not starting. The challenge is continuing. Because wealth building often feels boring. No fireworks, no excitement, no overnight transformation, just repetition. month after month, year after year. And modern culture fights against this mindset. Social media shows people becoming rich overnight. Fast money, instant success, massive wins. Your brain compares normal progress against extraordinary stories. Suddenly, slow wealth feels too slow. But slow wealth is often real wealth. Imagine building a brick wall. One brick feels meaningless, but nobody questions whether the wall exists after thousands of bricks. Investing works similarly. Small contributions feel tiny. Repeated contributions become powerful. This is why automatic investing systems work so well. Because automation removes emotion. You stop debating, stop timing, stop overthinking. You simply continue. Behavior becomes more important than motivation. Motivation disappears. Systems remain. And that difference quietly changes financial outcomes. Because most people underestimate small numbers. Imagine someone says, "You can become stronger by lifting something light consistently." Many people would believe it. But with money, people expect huge actions, big salaries, big investments, big risks. They underestimate ordinary consistency. And there is another problem. People think wealth building must feel exciting. It usually does not. In fact, boring often wins. Imagine two people. One constantly chases hot investments, new trends, new opportunities, fast profits. The other quietly invests consistently, year after year. Who usually wins long term? History often points toward consistency, because human emotions create expensive mistakes. Fear causes selling. Excitement causes buying high. Patience often becomes the advantage. There is an old investing truth. People frequently lose not because markets fail, but because behavior fails. And behavior gets tested during difficult moments. Market crashes, economic uncertainty, fearful headlines. That is when long-term thinking matters most. Because investing success is not just about knowing what to do. It is about continuing to do it. There is another benefit people rarely discuss. Identity. When someone invests every month, even small amounts, something changes psychologically. They begin seeing themselves differently. Not someone spending everything. Someone building something. Someone thinking long-term. Someone creating future freedom. Identity shapes behavior. Behavior shapes outcomes. Imagine two people again. One says, "I should probably save more." The other says, "I am someone who invests consistently." The second person usually behaves differently, because actions follow identity. Small investing habits quietly build financial confidence. Confidence creates consistency. Consistency creates growth. Growth. The cycle strengthens itself, and over years, that changes lives. Not overnight. Slowly, quietly, powerfully. The biggest value of investing $100 monthly may not even be the money. It might be becoming the type of person who understands delayed gratification. Modern life rewards instant gratification. Food arrives instantly. Entertainment arrives instantly. Shopping happens instantly. Investing teaches patience. Patience teaches discipline. Discipline creates opportunity. Because wealth building is often less about financial knowledge and more about emotional control. The ability to keep going. The ability to stay. That skill becomes valuable far beyond investing. Career growth, business, health, learning, relationships. Delayed gratification improves everything. And small investing habits quietly train that skill. Month after month, year after year, without most people realizing it. So what should someone actually understand from all this? First, do not underestimate small amounts. Small does not stay small. Time changes small things. Second, starting matters more than perfection. People spend years researching investments, waiting, optimizing, delaying. But action matters. Consistency matters. Time matters. Third, automate good decisions. Human emotions create friction. Systems reduce friction. Fourth, think decades, not weeks, not months, decades. Because investing rewards patience more than urgency. And finally, remember this. Your first $100 is not powerful because of the amount. It is powerful because of the habit, the behavior, the system, the identity shift. That is where long-term wealth quietly begins. At the end of the day, building wealth rarely looks dramatic. It usually looks ordinary. Small decisions, repeated consistently. Quiet progress nobody notices. Until years later, people see the outcome and assume. But often, the truth is much simpler. Someone planted financial seeds early and kept watering them. Because wealth is rarely built in giant moments. It is built in small moments people almost ignore. $100 every month, month after month, year after year. The strange thing is, most people think small habits cannot change their future. But sometimes, small habits are exactly what changes everything. And the question is not whether $100 can make a difference. The real question is, what small financial habit are you repeating today that your future self will thank you for